Welcome everybody to TradeGATEHub.com. I'm Coach and I'm joined by Darius Dale. I've been so looking forward to meeting you for quite some time, Darius. Welcome to TradeGATEHub. I've read a lot about you. In fact, how I normally start interviews, I don't have to do it with you because of your career path. So welcome, Darius. Great to have you.
Dale, it's such a wonderful pleasure to be here, my friend. Big fan. You guys do a lot of great work. So just happy to be here.
All right. And normally I start out asking people about their journey. And, they travel, God bless the broken road that led me straight to wherever I am now.
Mhm.
But definitely, I don't have to do that with you. I mean, all I have to do is say, Darius, when you were at Yale, were you thinking of getting into the trading industry then? What was on your mind? First of all, congratulations on going to Yale. How the heck did you get in there?
Well, you can see the helmet in the background definitely played a
Oh,
factor.
okay, all right.
Let's be
I'm
honest here.
glad you're my friend and not an adversary. You
Yeah,
still look like you could throw pretty good.
yeah.
You could
The
definitely
the
sack me,
the,
an
the
old man
fast
like me.
the fast twitch muscle fiber's still there, but the knees and back aren't. So I'm
Okay.
sitting in the chair all day.
All right. Well, anyway, gosh, you played Ivy League football. Did you have any dreams of going pro, or you knew
uh,
college was it for you for
No,
that level?
yes and no. I got a invite to training camp out of after college, but I was already starting to lose weight, and it's hard to maintain that force you put on your body. And knock on wood, you go to school like Yale, you don't really have to. So I was very fortunate to be able to kind of pivot out of football and into something that I love equally, if not more, which is investment research.
And Darius, I think you have to be like an athlete in this business, don't you? I mean, you have to be in a peak performing state. I know that when I come in, if I don't feel good, I'm not seeing the markets as clearly, or I haven't gotten the proper amount of rest. I'm
Mhm.
not as sharp, and I miss executions, or I just don't feel like trading, even though there might be a great opportunity staring me in the face. So I've noticed that athletes and people that had some type of discipline were able to make the transition
100%.
easier.
100%. It's I think finance, just relating it back to football, you got to be smart enough to understand the playbook in and out and be situationally aware, but you also have
Yes,
to have a short enough memory to not dwell on your mistakes and compound them, by trying to correct them. It's all about the next play. That's one of my big mantras at 42 Macro. It's focus on the next play, whether you had a good play
that's
or a
something.
bad play, good week or a bad week, good month or a bad month. It's always about the next play.
That's interesting. That's something that I say is the most important word for traders is next, not to,
Mm-hmm.
do postmortems, go fetal, that
Yep.
every trade should just be another trade.
Absolutely.
And don't get too excited when you're in a great trade, and then you won't
100%.
be right. So it's all in our heads, right? Trading's all in our heads.
Absolutely. You can
So
master your mind, you can master trading, but obviously it's a very difficult thing to do, not just in trading, but also in life.
I wanted to ask you about, we have paradigms that we come into the business with, right?
Mm-hmm.
And I read a little bit about your background, and we share something in common. And then I want to get to the markets. But when you come from humble beginnings, or you watch a parent struggle to raise you, and money was always an issue,
Mm-hmm.
that you really that develops a paradigm for you where you come from scarcity,
Oh, yeah.
right? And when you're as a trader, and it's something I had to work on for years, and found a way to solve it by just taking part of my positions off instead of being all in and all out.
Mm.
My problem was when I had a profit, because I came from there, I didn't want to let it get away. It was harder for me to risk profits than risk losses.
100%. I'm that way. I'm risk averse in both directions. I tend to want to generate, decent absolute returns, but I'm never going to be the guy that's riding arc, from let's call it 75 to 250, like that's just not me. I'll take it from 100 to 150 and maybe call it a day and move on. But, to me, it's more about risk managing the cycle rather than sort of squeezing every dollar out of the trade.
Okay, so 42 Macros, fairly new entity, isn't it?
Yes, sir. We're a little over a year old. I started this company April of 2021. Knock on wood, I guess we're 14 months old now and doing really well, man. Been very humbled by the reception we've gotten in the market. Very humbled by the partners we've been able to do business with and also collaborate with, like yourself. So it's been an awesome journey.
Okay, well, we're rooting for you.
I
I'm rooting
appreciate you,
for
brother.
you, Darius.
Thank
So
you.
let's talk about a few things. I know that you tweeted that you wanted to talk a little bit about FX and
Oh yeah.
that the sands might be shifting. So why don't we start off with the dollar that
Start with the
Pete?
big daddy of them all, huh?
Yeah, yeah. So I heard that UUP was the most popular ETF for a while during the stellar advance.
Wow, really? That's unusual, right? I mean, that in of itself, it tells you kind of where we are from a sentiment perspective. I had not
Right.
known that.
So do you have views? I believe that we're not going to make new highs in the dollar. A lot of people think that we will. I'm open to everything and anything, but do you think that we're looking at perhaps a significant top in the dollar? I know we had a little breakout. We're underneath the breakout, can't close above it on a weekly basis. And, normally when markets break out and then they're underneath, sometimes negated breakouts are the most powerful
Yeah,
trades to
100%.
me.
They call it outside reversals, right? I mean, from a
Yeah,
technical perspective, yeah. No, the dollar is likely to come under pressure from a couple of different directions. And I'm not saying that top is the top, but I
okay.
do believe that if we're having this conversation 6-9 months from now, it's going to be very difficult to see the dollar meaningfully higher. So one, we'll start with the change in policy rate dynamics in Europe. One way we could track this is through overnight index swap forwards, which are forward rate contracts on the benchmark policy rates. So the ECB's main deposit refinancing rate, be the Fed funds rate here in the U.S. And one thing that's interesting that is priced into the European curve that is not being priced in the U.S. curve is an upwardly sloping curve on a 1 and 2 year forward basis. Right now, our OIS curve is inverted. The 2-year OIS, 18-month OIS is actually below where the 1-year OIS, which implies the Fed is closer to the end of its tightening cycle than the ECB is, which means that the euro likely has some room to run if and when it starts to pick up. Now, that's not saying it's going to start now, but from a longer term perspective, I do believe that the dollar is likely to be challenged. And I guess the number two part of the comment I'd like to make is, we've dramatically outperformed our developed and even emerging market peers throughout this sort of COVID recovery.
Right.
For a
Yes.
variety of reasons. We've obviously had a tremendous amount of fiscal monetary stimulus. If you look at it on a GDP weighted basis, it's about as big as what we saw in the New Deal. But we also had better vaccines and more reopening. There's so many reasons that catalyze such a deep outperformance of the U.S. economy relative to peer economies, and that catalyzed such a significant amount of capital inflows. If you look at 2020 and 2021 on an aggregated basis, we're up over north of $6 trillion in capital inflows if you look at the change in our net international investment position. Now,
Okay.
historically, that has coincided with booms in markets, higher valuations in stocks, tighter credit spreads, et cetera. And that's exactly what we got. And I'm concerned that as our growth cycle really starts to slow down, particularly over the next 6 to 9 months, I'm concerned that a lot of those capital flows have come into markets to capitalize our current account deficit may start to go the other way and really perpetuate a dollar weakness and more significant slowdown in growth.
So if that's your view, are you starting to look at markets outside the US? If part of the bull market was a strong dollar and feeling comfortable that currency was at least stable, yet alone appreciating,
Yep.
if the tables are turning, is it possible that it could be Europe, or I know Brazil has been, all commodity producing countries have been
Yep.
doing quite well. Do you look for a continuation of that theme?
Yeah, absolutely. And not necessarily if in this particular time period, let's call it June 2nd through November 2nd, which is when we think the Fed will eventually pivot back to being dovish. This between June 2nd and November 2nd, it's very likely that financial conditions tighten from here. And
Okay.
so you might see an outperformance on a relative basis of those kinds of economies,
But still
it's not,
down.
but still down. Yeah, I think we've been in our research, really since going back to the fall, we've been sort of comparing this particular market, this particular economic setup to 2000 to 2002, that the unwind of the tech bubble. And it wasn't just the unwind of the tech bubble. There were a lot of very similar dynamics from a capital inflow perspective, then a capital outflow perspective that we see as a very similar risks, sort of, if you could call it fractal, if you will, from a similar set perspective. And so, if you think about that, what happened in the 2000 to 2002 downturn in the markets, you saw a significant outperformance in value over growth, significant outperformance of small caps over mega caps, and a significant outperformance over international and EM over US. And I do believe that is something that is setting up to be the case over the longer term.
Look where the Russell held.
Yeah,
Darius. Okay. I mean, going back to the 2018 high.
Mm-hmm.
And lately I've noticed, especially last week or the Friday before, when S&Ps were making new highs, the Russell did not.
Mm-hmm.
So do you think that, I know that you also are saying that this is going to be the most hated 20% recovery in the market in quite some time. So it's your view there, you could still be constructive this market for a while.
So let me no. So let me clarify that. That was
okay.
referring to the bond market.
Okay.
Yeah. No, definitely. I think the next 20% move in the stock market is lower. It's a very high probability that it's lower, at least according to our forecast.
Okay.
And in fact,
I'm glad you clarified it.
Yeah. Okay. Well, thank God. Yeah.
Yeah.
Don't want to make news today.
Okay. In fact, it's the bonds led it, right? So a lot of people are going to hope, and I don't know if you've ever seen this before. It's the first time in a long time I could remember risk off not giving a bid to bonds. Mm-hmm. In fact, bonds topped way before stocks.
Yeah.
And they led this decline. Mm-hmm. So here's a TLT monthly, 20% rally. I want to ask you, and I know what your company is, it's macro. So if we had, say, for example, one more low in the bonds, some Ellioticians are calling this a 4, and that we could take one more shot down to complete this bear move. Do you think that's on the table?
I think it is a 4. I definitely think it is a 4. And the reason I say that is we've been talking about this last few days. We were kind of analyzing the data, and we're in the disinflation camp, particularly from a headline inflation perspective. We're already starting to see core inflation momentum break down. If you look at core CPI, core PCE, tracking at around 3.9 for the latter percent, 3.9%. That's much lower than the kind of, right around 5% year over year rate. What I'm concerned about now, if we got the housing market statistics a couple of days ago, where we saw the year over year rate of home price appreciation actually accelerate to new highs in the most recent month in March and in Q1 respectively. And that is pretty telling because historically you've seen, kind of a 12 to 18 month lag between the peak rates of home price appreciation and the peak rate of owner's equivalent rent and shelter CPI, which tells you this massive weight in the core CPI basket, the core PCE basket, is likely to continue accelerating over the medium to long term, which tells you that we got a lot of work to do to get inflation down if it's just going to be coming from the good side of the equation, which has already slowed pretty significantly. And, you think about that, the upward pressure we're seeing on services as a function of what I just said, and also the upward pressure on headline inflation from the trend higher in crude oil, the trend higher in ag prices. To me, I'm concerned that the market has gotten ahead of itself in pricing in this sort of 250s and maybe a pause kind of narrative. And the reality is, I'm not so sure that we've seen the peak pricing in terminal Fed fund rate expectations.
What are you looking for by November when he may turn?
Oh, well, so I'm looking for by November is a significant slowdown in the growth cycle that tightens financial conditions enough to cause the Fed to feel comfortable that wherever inflation indicators are at that particular moment in time, they'll be a lot better in some future state in time. Right now, I don't think the Fed has any confidence. If you look at, again, as I mentioned, the 3-month annualized rate of change in core PCE at just shy of 4%, that's a double of what their target is. There's really nothing that you can look at and hang your hat on from an inflation perspective, either report it or in financial markets. If you look at 5-year forward inflation swap rates to say that the Fed is achieving its objective anytime soon. And so I think we need to see financial conditions tighten for them to get comfortable that they're achieving their objective.
And Darius, I'm a couple of years older than you, but
just a couple.
I was actually trading when Volcker was the chairman.
Oh, that's fantastic.
And went through that. And take a guess, what was the last market to finally capitulate to 19% rates?
Ooh, if I had to get, I mean, sounds like the stock market.
It was corn.
It was corn.
Because
Wow.
the Fed can't print corn. How
Yeah.
are they going to contain inflation with things that grow
Yeah.
in the middle
100%.
of a drought, in the middle of a war in Ukraine where a third of the wheat supply is the only one getting it are the Russians in trucks taking
Yeah.
it from Ukraine?
100%.
They might be able to do something with oil. I can't find an oil bear anywhere. It's very unusual. And I think we held a pretty important point today, but
We did.
you think it's possible, right? We held this 112 area,
Yeah, that was
so
important.
maybe there's another run. But are you in the 150 camp, 200 camp, or is there anything that you could think of besides what the Saudis might do that could take crude back down under 94, which would change the picture dramatically for crude?
Yeah, I'm in the camp of wherever oil is going to be when it starts to break down in our signal. I mean, that like
Yeah,
I don't know. I don't need a price target to be long crude oil, but I need
right.
a signals that'll help me get out of the trade. And in terms
Okay.
of the signals that help us get out of the trade, we built a pretty sophisticated market regime nowcasting system at 42 macro. And right now
Okay.
we're still pricing in what we call inflation. That's the
Okay.
regime where growth slowing and inflation is accelerating. Deflation is now the second most probable regime, but it's a distant second. When that regime shifts to deflation, it could be obviously led by crude, it could be led by another other factors in the model. There's 42 total factors in that model. If any of those 42 factors or the compendium of them shift to deflation, I'm out of the oil trade. I'm out of the long commodities trade because that'll be a leading indicator that a lot of positioning has to get wrestled out.
I know that you're involved in the crypto markets.
Mm-hmm.
Read about that, but that old debate about what's better, gold or crypto. What's your view on precious metals? Everyone's saying, Darius, it was a terrible inflation hedge. Well, correct. That's because it's a monetary hedge,
Yeah, right. Yeah, no, it's
right?
yeah. I would argue it's gold is both an inflation hedge and a deflation hedge, which tells you what it really is a store of value. I mean, if you
Yeah.
look in terms of how back the big upward surges we've seen in gold prices historically have come in during both times of inflation and during times of deflation as well. So it's not that's not neither here nor there to say. What it's been is it's an inversely correlated position to real interest rates. And as long as we have real interest rates trending higher, we actually had new highs recently on the 10-year tip shield.
Right.
We're going to see gold struggle, and of course, gold is also going to struggle in an environment where there's just incremental supply in terms of these types of assets. So we've been negative gold. We haven't been short gold, but we were long gold. I think we sold it for a very small loss and just have been sort of marginally negative since then.
Okay. I think they're turning.
Yeah. You think
Here's just a quick look at GDX, and it's going to take a dollar turn. If the dollar Dixie goes to 107, yeah, but as long as gold is holding that 1780 level, it looks pretty good to me. And some of these miners, there was actually a takeover of by Goldfields of Yamana. It ended up being a take under because Yamana shareholders didn't like it. And Goldfield shareholders really didn't like it.
Yeah, geez.
Okay, but I think it's a sign, and you're more of an economic guy than me, that perhaps a lot of these junior miners are going to be acquired by larger miners because it's easier to buy production than to create new production out of their mines.
100%.
What do you think?
No, I think that's the most rational position you should take. And this is precisely the amount of time, the place we should do it. When, I wouldn't say gold's in a bear market, but it certainly is not in a bull market, at least according to our model. It's actually bearish from our signal.
Okay.
This is when you would be consolidating. Consolidating is appropriate, particularly when real interest rates are as high as they are. This will be a windfall to once the gold price starts to recover, as I suspect it will once we get to the pricing in deflation. Again, as I mentioned, we're still pricing in inflation and a higher, trend higher in terminal Fed funds rate expectations. That'll stop at some point in the next, let's call it 3 to 6 months. And eventually I think gold will find a durable bottom at that point in time.
Okay, so it sounds like everything could be under pressure until the Fed turns. So
risk assets for sure. I think bonds and duration sensitive assets, particularly style factor risk within the equity market, will front run that Fed turn. But I don't know that risk assets from a absolute return perspective can front run it meaningfully enough. Maybe if there's enough tea leaves from a commentary perspective, but I do believe that turn is going to mark a durable bottom in risk assets.
Okay, so possible turn in the bond market, but you think this is a 4. So you're looking to buy bonds. What kind of bonds? I've noticed.
EDV, give me that juice.
What is it?
The EDV, that's the juice on the long end of the curve. That's the extended duration treasuries.
Okay.
TLT, you can put TLTs.
So that'll fly in the face of the great steepening by guys like Joseph Yang and stuff.
Yeah, and so and to me, this is part of the reason why I think there's a 5 coming. Is citing his work. There's a tremendous.
Is this it? EDG is Goldfield's ADR.
Sorry, no. EDV is in Vanguard.
Yep. Victory.
Yeah, Victory. Yep.
Right.
So no, I tend to agree with Joseph Wong, who's a brilliant investor or certainly obviously a really thoughtful guy who understands the plumbing of financial system as well as anybody in the world. And if I'm happy to take his word for it in terms of the illiquidity that the treasury market has accumulated in recent years, it's obviously going to be a big deal, and it has been a big deal. Year to date, it is very likely to be a big deal when Janet Yellen starts to issue coupons in size in the coming months. That'll probably be your 5. But as that's occurring, don't forget you still have pension funds all over the world,
right?
Insurance funds all over the world that are saying, "Hey, look, we are in fact at the peak of what could be a multi-year inflation cycle. Oh, by the way, growth is really starting to slow. If you look forward a year in time, look forward 2 years in time, these Fed funds rate expectations, ECB rate expectations, they're going to be mispriced at some point in the next, call it 6 to 9 months. And the bond investors will take advantage of that."
Okay, so we'll finally see a flow. It could also be with your outlook on the market that they finally catch a bid on the next wave down to maybe you have any kind of target with your analysis in the S&Ps, like 3,400, 3,000.
In the S&P, yeah. So we do have, there's a couple ways we get to. So we have a 3,200 to 3,400 sort of range for a durable bottom in the S&P. That's sort of our Fed put range. And the reason we get there, there's kind of 2 different avenues with which we get there, technically and fundamental. Technically is easy. We just we think the 3 most relevant market analogs to the current setup are 2018 in terms of the Fed tightening into a slowdown, 2011 in terms of the inflation dynamics catalyzing a significant slowdown in growth, and then 2000 to 2002 in terms of the overvaluation of the market into a downturn. So when you put those 3 analogs together and you look at it on a Fibonacci retracement basis, you're getting to something that looks like down 30% peak to trough S&P. So that's the technical aspect of the trade. The fundamental aspect of the trade comes through sort of 3 lenses that we think are very important to kind of quantify downside risk in any bear market. One, there's the positioning side of the trade, which we show as the household equity ownership as a ratio to overall net worth. That's at 30% at an all-time high. You typically have about a 22% drawdown in the S&P when that ratio peaks.
Retail hasn't given up yet, have they?
Oh, they're still buying the hell out of the dip.
Okay.
Number 2, you have valuation. S&P 500's real earnings yield at an all-time low negative rate. There have been 6 inversions in that metric since going back to the early 1970s, and the median drawdown in the S&P there is minus 43%. And then lastly, from a business cycle perspective, one thing we look at to measure the kind of labor market, one easy statistic to measure where you are in the business cycle is looking at the Conference Board's labor differential survey. Historically, when that measures peak, you've seen an average of a 35% decline in the stock market. So when you put those 3 things together, you still get to down right about 30 to 35% in the stock market. So this goes to our 3,200 to 3,400 range.
Okay. So it's a very interesting argument. You're like a good attorney. Okay, because you build your case. All right. And it's not just one thing. It's not just technicals, and it's not just fundamental. You marry them. You bring as much evidence to the table for your narrative as possible. Is that what gives you conviction? It's a confluence of all these things coming together, Darius.
100%. It's never just one thing. It's always a bunch of things. And the more stones you can uncover, the more you can have conviction. It's not that you're going to be right. It's just that you're going to understand what causes you to be wrong better. And you'll be able to react sooner to information that causes your positioning to be wrong. And that to me is more important than just kind of assuming you're going to be right ex ante. We all do.
So how long does QT last? Until November?
Yeah, I think
Because it started yesterday, right?
I think they'll probably they'll start winding it down in November in November 2nd meeting, at least according to our models. So it's incumbent upon the growth slowdown. So we have a forecasted growth slowdown that'll start to really pick up in earnest in July, August, September. And that in conjunction with our views on the profit cycle, we think we're sort of heading towards what could be a very narrow but meaningful relative to expectations recession in corporate profits. We're not necessarily have to forecast an outright recession in the economy, but I do believe that corporate profits are a little bit more vulnerable here.
And they haven't priced that in.
Have not even come close. In fact, I don't know if you want me to share my screen, but
yeah, sure, go ahead.
Yeah, please.
Let me stop.
Yep. Yeah. So here you go. So this is our May macro scouting report. Every month we put together one of these slide decks, and Dale, you hit the nail on the head. As a good lawyer, 136 slides in this one. There's usually about 125 slides.
Yeah.
So in terms of corporate profits, and this is updated as of yesterday. This blue line shows S&P 500's next 12 months earnings yield, or not earnings yield, sorry, EPS. So we're hitting new all-time highs on EPS, despite the warnings we've seen from Target, Walmart, Google, Netflix, Peloton, Nvidia. These are some major companies that are having problems with their P&L and their fixed costs, and the pin action on their fixed costs. And we haven't even seen the big growth slowdown yet. The big growth slowdown, at least according to our models, is ahead of us in this kind of second half of the year months. So that's going to be a problem if those fixed costs don't get in line soon enough.
Not even in 2000, Darius, I can't remember stocks losing 25-40% of their value overnight. It might have taken a month. And that would have been considered a very intense, but just these huge gaps that are leaving so many people trapped. Because most people, I know that Ackman did it with what was it, PayPal, or where he took the loss, or
just ate it.
Yeah, and it's not easy to do when all of a sudden the holding you have, you wake up the next day and it's down 25 to 50%. To me, do you think that there's a problem with market structure? I always said, I wish we still had specialists on the New York floor, that they provided an important function in between the machines, that they had to make bids to make the market efficient. Do you see any kind of like cracks in the system that we could have these kind of moves?
Without question, there's a problem in market structure, and this chart is not going to explain why there's what the problems are, but it will explain why we have problems in market structure. It's the liquidity. We've created an entire generation, and I don't mean by age. I mean just as you, Dale, and this Dale. We're probably separated by a couple decades, but we all have the same.
Don't rub it in, buddy.
No, trust me.
No,
trust me. That's not me rubbing it in.
We probably are, son.
No. But my point is, we all have this sort of the aggregate level of risk taking in the economy and in financial markets is significantly higher than it's ever been, because at every interval we've always had this thing called a put, the Fed put, the BOJ put, the central bank put. And now we're at a situation where inflation is not going to allow that put to get activated as quickly as enough. And so from a market structure perspective, we're trying to exit trades based that were built in this environment where it was very appropriate to take a significant amount of risk. And now we're in an environment where it's no longer appropriate to take a significant amount of risk, and there's nobody on the other side of the trade to get you out of the position.
Yeah, no bids underneath.
No bids. Yeah.
Darius, after talking to you for half an hour, I know why you're so popular and everyone wants to
I appreciate that,
interview
man. Thank
you. I really, I know we only touched, just maybe the top of some of your research. It's top notch, and best way for people to, follow you and get your research would be to go to your website.
Yes, sir. It's 42macro.com. I'm pretty active on Twitter, although I haven't been recently, but 42macro D Dale. And by the way, Dale, you do such a great service for so many people. I mean, this is one of the things that I think is the coolest part about where we are as an industry right now. Is the people with your experience and your knowledge and your acumen are willing to share it with so many people. And I'm very grateful. I've learned a lot from you, from a lot of other people. And it's very awesome. It's very humbling to be a part of that now.
Thank you so much, Darius. I say, what good is anything until it is shared with another?
Wow, that's a beautiful comment.
Buddy. And
Yeah.
I want to thank you for sharing your great work. I'd love to talk to you again down the road, Darius. You are definitely a pro, and I know that your business is going to be a mushroom.
I appreciate that so much, Dale. Thank you very much for having me. I'll catch you next time.
All right, everyone, Darius Dale, and you could follow Darius on Twitter at 42 Macro D Dale, like my first name.
Absolutely.
All right, see you, Darius.